What does the future of wealth management look like? Well, here to talk with me about this is Tony Davidow, author of a forthcoming book called Goals-Based Investing. Tony, give us the 60-second version of the future of wealth management.
Yeah, thanks for having me, Bob. And yes, I think there's a lot of changes going on, some of which we've started to experience over the last couple of years, some of which is driven by COVID. But I think there's one big macro theme throughout the whole book that I talk about in this article, which is we're starting to see a bifurcation of advice, highly customized advice, which is being demanded by high net worth investors, and lower end clients being gravitated or pushed to a robo offering. So we're starting to see that bifurcation of advice. And I think there's a couple things that fall out of that. One is a need for the higher end of the market to have more dedicated teams, more super teams kind of emerging, a migration to goals-based investing, which is more appropriate for high net worth investors. And at the lower end of the market, we're starting to see, the ability to customize portfolios with direct indexing and ESG, all delivered through a robo-type offering.
And then the article you mentioned, and in the book, you also mentioned some of the big trends that are occurring. For instance, the RIA segment continuing to grow. Tell us more about some of these trends that you see.
Yeah, I think the RIA segment has certainly been growing, and I think it will likely continue to accelerate. And it's not a one-size-fits-all. So it's really a broader set of independent sort of solutions. Somebody can hang their own shingle. Somebody can be part of a big aggregator type model, or somebody can have some sort of a hybrid solution. But I do think that growth of the independent model is certainly going to continue over time. I also think one of the things I talk about in the article, which we're starting to see a little bit of evidence of it, and you and I were talking recently about a article that Michael Kitces had done some research on this. The fee model is changing a little bit. So we would all argue that the asset-based fee is preferable relative to a commission-based model. But that, of course, ties the success and failure of a relationship to the performance. But we all know that sophisticated advisors are offering so much more. They're offering financial planning, they're offering estate planning, they're potentially dealing with large concentrated positions. All of those things are nice and important, but they're not actually captured in that relationship. So could we start to see different sort of models? And McKinsey actually suggested, the future could see us having a Netflix type subscription model, which I actually think is something that makes an awful lot of sense, where a relationship is really built on paying for a series of services, not just your asset management.
So I certainly, there are some firms that are offering subscription services now. It hasn't taken flight yet, but I can envision a future where that becomes the predominant model if advisors can figure out how to make money doing it relative to the asset-based model. So tell us a little bit more about the investment opportunities. What we've witnessed is I think the democratization of investments, and there's yet one more iteration of it to come, I think, and you mentioned it in your article.
Yeah, I think we've seen a lot over the last couple of years, and I think it's the tip of the iceberg. So, one of the things we certainly focus on quite a bit is private markets, really provide an incredible opportunity. And it's a topic that I've certainly written about and spoken about quite a bit over the last couple of years, but I do feel it's kind of the tip of the iceberg. So, private markets, private equity, private credit, and real assets have typically only been available to ultra high net worth families and big institutions. You're starting to see them become available in registered fund products, whether they're tender offer funds, interval funds, non-trader REITs, BDC. So you're starting to see a lot more of those strategies coming to the market. And I think they afford great opportunities in an environment that likely will deliver lower returns in the future. I think advisors and investors are going to have to seek other ways of increasing the returns in their portfolios, increasing the yield, and finding ways to hedge the impact of inflation, a topic we really haven't had to think about for the last couple of years, but I think is going to be front and center going forward. So I think private markets is a really interesting opportunity. I also touch on hedge funds, which have been a little out of favor recently, partly because I think there's been a mismatch in expectations, investors and advisors not really understanding the role that they play in portfolios. But I think we'll likely start to see a reintroduction of alternatives, hedge fund type strategies. But I suspect that maybe we'll see them at lower fees and greater transparency, which I think is what the market's really demanding.
There are two other opportunities that you wrote about in the article that I'm intrigued by. One is the notion of direct indexing, and the other is the growth of model portfolios. Care to talk a little bit about those?
Yeah, so direct indexing is very interesting because it had always been very cumbersome to build index-based products. If I wanted to own the S&P 500, many years ago, it was very difficult because I had to buy 500 stocks in the right weight. Now ETFs come along, and now we can buy them with a single stroke of a mouse. But direct indexing is pretty interesting because now with fractional shares, you now have the ability to say, I want to customize my portfolio that kind of fits what I believe in, what I want in my portfolio, whether that's having an ESG sort of screen, or it's just, you're a tech executive and you want to avoid technology in your portfolio. Direct indexing makes this a pretty elegant way of having a portfolio that is customized for you. And again, fractional shares, I think, have helped accelerate that. I think that trend will continue. And I think a lot of firms are putting a lot of muscle behind that. The other one, of course, is model portfolios. And again, I think this is an area that's very interesting because as the advisor's value proposition is shifting, right? Their value isn't just beating the market. Their value is serving the complex needs of high net worth clients. And all of these needs require resources and time and commitment. I can see a day, and I think we're starting to see that now, where advisors are saying, well, my expertise is really being the quarterback of the relationship. I can leverage somebody else who has the expertise to build model portfolios that reflect one or more different sort of views, and they can be goals-based oriented, they could be ESG oriented, it could be a combination of models, but ultimately I'm farming that expertise out to a third-party asset manager who can have pretty sophisticated asset allocation modeling techniques. I think at a point in time we'll likely see a broader set of strategies, even including alternatives in those models. And then they're responsible for doing the rebalancing and adjusting to the changing market conditions. It doesn't lessen the value of an advisor. I'd argue it actually enhances it because it gives them a broader set of teams that they're bringing to their clients.
So given these trends, given these investment opportunities, what's the best way for the advice profession to respond to this changing landscape?
Yeah, and something you and I have talked about quite a bit. I think advisors need to lean into it. They need to accept that the world is changing and they need to embrace it. They should be excited because they're not going to have access to a broader set of investment strategies than they've ever had before. They should embrace the fact that technology will enable a lot of these things, make it much more efficient to run their practices. They should think about evolving their practices and bringing in younger and more diverse professionals just so they can better align with the clients that they serve. So to me, it's an exciting opportunity because this industry is evolving. If we were stagnant and doing the same old thing, it would be kind of boring. But the fact that we're evolving and the fact that we're evolving in a very positive direction, I think is something advisors should embrace.
Yeah, and I like how you close the article, Tony, by saying that those who don't accept this change and embrace this change risk becoming obsolete. That's good incentive, I think, for many.
Unfortunately, that could be the outcomes.
Well, Tony, thanks for sharing your knowledge and wisdom about this. I'm sure it'll help a great many advisors who are trying to anticipate what to do in the future.